Welcome to the Deep Dive. We're your source for cutting through the noise, especially around these really important earnings calls.
Exactly. We break down the critical insights you need, get you up to speed fast.
And today we are diving deep into the second quarter 2025 earnings call. This one happened pre-market July 31st.
Right. The release was 6:30 a.m. Eastern, and the call itself kicked off at 8:30 a.m.
So our mission today...
Simple, really.
Yeah.
We want to quickly get you dialed in on the key takeaways, management strategy, what it all means for healthcare overall.
Help you connect the dots, especially with all the turbulence out there.
You got it.
Okay, so let's jump in. Results first. The market reaction was, well, pretty strong right away. Negative, actually.
Yeah, we'll get into why that might be.
All right.
But the actual results, pretty solid.
Definitely. What jumped out at me first was the top line beat. Total revenue hit, $67.18 billion?
That's a big number. A 7% beat versus consensus expectations.
And 11% growth year over year. That's significant.
It really is, especially now. And looking at earnings, adjusted EPS came in at $7.20.
Yeah, just slightly ahead of the $7.16 consensus, right?
Yeah, a narrow beat there. And GAAP EPS, $5.71, also up from last year. So growth on both fronts.
Okay, and the MCR, the medical care ratio, always a key metric.
Stood at 83.2%. That was actually 20 basis points, so 0.2%, better than the street was expecting. Good for profitability.
But the real engine here, it seems, was Evernorth. That's their PBM and specialty services arm.
Absolutely. Its revenue surged 17% year over year. Huge growth.
To $57.83 billion. I mean, that basically drove the whole top line beat, didn't it?
Pretty much. It just underscores how central that segment is becoming to their whole story.
So let's connect that to what management was saying. The CEO sounded, well, pretty confident.
Yeah, he really hammered the point that they're meeting financial commitments, focusing on innovation, access, affordability.
And they backed it up, right? They reaffirmed the full year guidance.
They did. Adjusted EPS still expected to be at least $29.60. And that MCR outlook, 83.2% to 84.2%, also reaffirmed.
Okay, so holding firm despite sector headwinds.
Although they did flag that the third quarter MCR would likely be towards the higher end of that annual range. Something to keep an eye on.
Got it. So confidence, reaffirmed guidance. This all ties into a really big theme from the call, didn't it? This intentional pivot.
Oh, absolutely.
Yep.
The move away from what they termed volatile government programs. It's a major strategic shift.
They sold their Medicare Advantage business earlier this year, so now zero exposure to Medicaid or Medicare Advantage.
Exactly. It's like they saw the storm clouds gathering over MA utilization and just decided to get out completely.
So what are they focusing on instead? What's the safe harbor?
Three things they call their fee-rich engines: commercial medical, the Evernorth pharmacy benefits we just talked about, and their specialty distribution arm, which is growing fast.
Fee-rich meaning they make money from services, not so much from taking insurance risk.
Precisely. It makes earnings potentially more predictable, less tied to those swings in healthcare usage we've seen elsewhere, particularly in Medicare.
And they reiterated that long-term growth target, 10-14% compound adjusted EPS growth.
Yep. And importantly, they plan to achieve that through disciplined share buybacks, not big M&A deals. They specifically mentioned abandoning previous talks on that front.
So focused execution, buying back stock, avoiding risky mega mergers.
That's the narrative.
Okay, beyond the financials, what about innovation? That seemed like another key point.
Definitely. They're investing in new solutions. One that stood out was an AI-powered virtual assistant.
Aimed at making things easier for members, like checking benefits, estimating costs. Sounds useful.
Hopefully. And maybe reducing their own admin costs, too. Then there was the big move on the pharma side.
The GLP-1 weight loss benefit.
Yeah, this is a big deal. They launched a new benefit structure that caps patient out-of-pocket costs at no more than $200 per month.
How'd they manage that?
By negotiating directly with two drug manufacturers. It gives patients choice, predictability, and it directly tackles those high drug cost optics. It's aggressive.
Could definitely pressure competitors. And Accredo, their specialty pharmacy.
Also strong. Double-digit earnings growth there. And they mentioned biosimilar conversions are running ahead of schedule, which provides a margin boost.
So these fee engines, especially Evernorth, sound to be firing on all cylinders.
It's now over 60% of the whole company's earnings. Its role is just pivotal.
And within Evernorth, the specialty and care services part grew revenue 13% to almost $26 billion.
Right, pre-tax adjusted earnings up 12% year over year, if you normalize for investment income shifts. strong performance.
And that whole specialty market is just enormous, isn't it?
It's huge, over $400 billion, growing high single digits every year. And think about this. Last year, something like 70% of new FDA-approved drugs were specialty meds.
Wow. So that's where the action is.
Absolutely. And their CuraScript SD business plays right into that.
That's the one distributing complex specialty drugs.
Yeah, to thousands of providers, health systems. It's already a $25 billion business itself, growing double digits.
And it taps into the part of the specialty market that goes through the medical benefit, not just pharmacy.
Right, about 40% of it. It's a massive channel they're plugged into.
And they're also helping hospitals manage their own specialty pharmacies.
Yes, which is clever. Hospitals are facing margin pressure, so running their own pharmacy, especially for high-cost specialty drugs, can be a revenue source.
So the company provides the procurement, the tech, the coordination, makes them a partner.
Exactly. Embeds them deeper in the system. It's a smart, sticky strategy.
Okay, but let's talk costs. Always the elephant in the room in healthcare. The MCR was good this quarter, but management did say elevated cost trends will stick around through 2026.
They did acknowledge that. You can't completely escape gravity. However,
What's the however?
the pricing environment for 2026 renewals, they described it as firm and rational.
Meaning they expect to get price increases.
More than that, they expect increases that exceed what they got in 2025, which were already pretty high.
How can they be so confident?
Because most of their U.S. employer business is self-funded or client-specific. They're not taking all the risk. They can negotiate pricing more directly based on actual expected costs for that client group.
Got it. Less exposure than fully insured plans. And what's driving those underlying cost trends? Still the same culprits.
Pretty much. Specialty injectables are a big one, and behavioral health services continue to climb.
It's also interesting they pulled back so much from the individual exchanges, the ACA market.
Right. That was a very deliberate move back in 2023. Cut their membership there from nearly 1 million down to under 400,000.
Why? Just chasing margin.
Essentially, yes.
Yeah.
Prioritizing margin and stability over just sheer growth in a volatile market segment. They put through price hikes there roughly double the industry average in 24 and 25.
So that move kind of shielded them from some of the pain others felt in that market.
Exactly. It insulated them from some of those utilization surprises that hit peers harder.
Okay, one less cost point. That sophisticated hospital billing. Maybe using AI. Management acknowledged it, but seemed confident they could manage it.
Yeah, they basically said, look, providers might be getting smarter with coding and tech, but so are we. They believe their own AI and analytics can counter that effectively.
A tech arms race, almost.
Sort of. They aim for a net balance, using their tech to manage the costs driven by others' tech. A proactive stance.
All right, let's pull back investor context. That immediate 6% stock drop pre-market, it feels like the market wasn't reacting just to this company's results.
I think that's fair. It seemed driven by broader sector fears, the rising utilization worries hitting other managed care companies, especially those still heavy in Medicare Advantage.
So they got painted with the same brush initially.
Seems like it.
Oh,
What's interesting is the buy-side reaction, the big investors. They apparently saw the sell-off as overdone.
Because the actual results were fine and guidance was held.
Exactly. And despite lagging for the year, this stock actually outperformed the main healthcare ETF, the XLV, over the last quarter. So there's a disconnect.
A disconnect between the knee-jerk market reaction and maybe the underlying story here.
That's the interpretation. The market might be missing the impact of that strategic pivot away from government plans.
So what are the key things to watch now? What could prove their case?
Well, there's a September Investor Day coming up. We should get updates on capital allocation then.
Always important.
Then looking ahead, the January 1 pharmacy renewals and the whole 2026 rate filing cycle. Those will be real tests of this cost trend-proof idea.
Can Evernorth really keep delivering and offsetting broader pressures?
That's the key question. Plus ongoing PBM legislative talks and how well that new GLP-1 benefit takes off. Lots to watch.
The big picture narrative seems clear, though. Shift from traditional insurance risk to diversified fee-based health services, compounding cash without the Medicare volatility.
Right. And if Evernorth keeps firing and costs stabilize like they predict, that post-earnings dip might look like an opportunity for the stock to, get revalued higher.
Okay, perfect transition. This is the deep dive, and it's time for our This Is Not Financial Advice segment.
Let's do it. So we saw that nearly 6% drop right after earnings.
despite a beat and reaffirmed guidance.
Exactly, which, as we said, analysts called overdone. It suggests the market maybe got spooked by sector headlines, maybe overthinking cost trends.
And perhaps overlooking the strategic shift and the strength in those fee-based parts like Evernorth.
Precisely. So considering that potential mispricing and their confidence in guidance, especially on MCR and EPS.
What's the outrageous but plausible trade idea?
Okay, here it is. The thinking is, if the market's got this wrong, there could be a significant rebound, especially after Q3 results maybe prove out their story.
So how do you play that?
Go long the stock, but add some leverage. Buy out-of-the-money call options expiring after the Q3 earnings call.
Betting on a significant pop post-Q3, high risk.
High risk, high potential reward. And to offset some of the cost, you could sell at-the-money put options.
Collecting premium, but agreeing to buy the stock at the current price if it drops.
Right. It provides a bit of a buffer or income, assuming you believe the fundamentals limit the downside risk. It's a high-conviction play that the market will correct that overdone sell-off once Q3 data hits, especially if the MCR holds up and Evernorth shines again.
A bold move targeting a specific perceived mispricing. Got it.
It's definitely out there, but plausible if you buy into their narrative arc.
All right. So to wrap up today, we've covered the strong Q2 results, that really significant strategic pivot towards fee-based services, the innovations like the AI assistant, and that potentially disruptive GLP-1 cap.
And despite that initial market dip, the numbers themselves and the reaffirmed guidance paint a picture of a company trying to build a more resilient model, insulating itself from some of the wider industry storms.
So the question for you listening is, what stood out most? Was the market reaction truly overdone? Or are there risks we didn't fully capture that still make you cautious?
Yeah, we'd love to know what you think.
And just remember, everything we've discussed here on the Deep Dive, it's for informational purposes. It is absolutely not financial advice.
Please do your own research, connect your own dots, and always talk to a qualified financial professional before making any investment decisions.
Absolutely. Thanks for joining us on the Deep Dive.
We'll keep bringing you the insights you need to cut through the noise. Join us next time.